You're listening to Lender Lounge with Kevin Kim, a podcast dedicated to the private lending industry. I'm Kevin Kim, and my goal is to sit down with key figures in the private lending industry to talk about their business and their personal lives. We'll get their takes on market conditions, the industry at large, and their personal stories. Overall, I really want to learn more about how they started and grew their businesses. So whether you're a lender, a borrower, a vendor, an investor, or anyone just interested in learning more about private lending, this podcast is definitely for you. Thanks for tuning in and enjoy this week's episode of Lender Lounge with Kevin Kim. Before we move on, I really want to tell you about a great sponsor that's joined us for the show. Private lenders, this one's for you. If you're not currently automating your internal operations, you're likely spending a lot of time on tedious manual processes. If increasing efficiency and generating more business is your company's goal, automation is the answer. Recently featured in Forbes and Entrepreneur magazine, Mortgage Automator is a complete loan origination and servicing platform designed specifically to optimize your processes and automate your tasks, including all of your communication with the various parties involved in your transactions. It can help you generate and send off documents, such as term sheets, in seconds for digital signing. It's also able to handle your payments, collections, accounting, and so much more. Focus your team on growth and let Mortgage Automator handle the rest. Go to mortgageautomator.com to book your personal demo and find out how Mortgage Automator can help your business grow. All right, guys, welcome to another great episode of Lender Lounge with Kevin Kim, our great podcast here at Jurassic. And today we have a very special guest with us, Eric, a good friend of the firm's for a long time with Roc and Roc360. Thank you very much for joining us, Eric.
Thanks, Kevin. Thanks for having me. Happy to be here.
Let's get started. Just tell us a little bit about yourself and the company, and introduce yourself to the audience. For those of you who don't, for those who don't know Roc, you guys have a pretty much of a household name today. But introduce yourself and the company, and we'll go from there.
Sure, I appreciate that. I'm Eric Abramovich. I am co-founder and chief credit officer at Roc360. Roc360 is the parent company to several of our brands, including Roc Capital, which is how we're mostly known in the marketplace. We have other companies, a direct-to-borrower company called House Lending. We have an insurance company called Elmshore, a title company called Wimba, and these elements, the composition that is Roc360, that is how we envision servicing the real estate investor space. And in that, I guess I should go to our mission statement and brand promise. And I think that'll kind of make it clear. Our mission is to be the most innovative, trusted, and disciplined financial services platform for resi real estate investing. And our brand promise is basically our platform connects Wall Street to the farthest reaches of Main Street, efficiently transforming fragmented real estate markets and rebuilding the core of American real estate.
You guys have been around since the last cycle, right? You guys started up in 2009, right? So you guys have been resi this entire time.
Well, actually, yeah, there's certainly a backstory behind that, and let me explain that. So, basically, the three of us met, the three co-founders, Arvind Raghunathan, Max Stavinsky, and myself. We met around 20 years ago. I was a student at the Stern School of Business at NYU, and Max was a classmate. Actually, Max somehow got his way in and got a job at the time. Arvind was running a prop trading group, a quantitative long-short trading group at Deutsche Bank. It was the internal group was called Equitech. And we were running. He was a very successful trader or portfolio manager. He had been running a strategy, and Max got a part-time job. He went as well for freshman or sophomore year. I think at some point he got overwhelmed with the amount of work and studies. And one day we were in macroeconomics class, and he kind of tapped me on the shoulder and said, "Hey, you need a job, or we're looking for help." And at the time I was kind of reluctant, and I thought, my God, I just started my freshman year, and now I'm going to go work at a bank. I mean, that seems like a lot of kind of work to take
Is
on.
it right in the first year of B school, or like you're in?
Well, that was undergrad. So I was
your first year undergrad.
So
Wow.
So I don't think I was 19 years old yet. So I kind of remember having my 19th birthday at the offices there. And I was 19 years old, part-time job, running uptown and downtown between NYU and Midtown, the offices at Deutsche Bank and that's how it all started. And at that time, that was one of the, if not most successful groups within Deutsche Bank in terms of the strategies that we were running, but very different from what we do today. Mm-hmm. And that evolved. I eventually graduated, and I was given some capital to manage. Max was managing the European portfolio, and I was put in charge of the Asian desk. Mm-hmm. For our group. I actually lived in Tokyo for a bit. I lived in London. I lived in Tokyo for a bit.
Awesome.
And I was running the Japan strategy, and Arvin was running most of the book, which was here in the US. And that worked very well for a few years, and then came the financial crisis.
Right.
And then, actually, interestingly enough, it continued to work well for us while the world was kind of going sideways or underwater, you could say. For us, things went quite well. The only problem was that banks were no longer allowed to do what we were doing. That is, they were no longer allowed to use their balance sheet to make speculative bets on markets,
right?
Essentially. And so because of new regulations that came about the result of the financial crisis, we were forced to spin out. Mm-hmm. And that was the beginning of what I call Roc Capital 1.0.
Right. And this is 2009. So this
is 2009, and we actually spun out and formed the biggest. It was the largest hedge fund launch post the crisis in the world globally. It was a $1.3 billion launch. Mm-hmm. At the time, it was a big event, and we went on and continued running the same strategies. But as luck would have it, the very things that worked great pre-financial crisis, for whatever reason, stopped working. And we continued managing that strategy for 4 or 5 years. We were just flatlining. We didn't really lose any money, but we started to lose our faith in what we were doing. And there were many reasons for that. I mean, technical reasons. We were running a quant strategy that generally played on trends in the market, reversion, momentum, things like that. And the quantitative easing that the Fed was doing post the financial crisis basically caused correlations in the market between stocks to go up, and when everything goes up together with a correlation of 1, it's very hard to play spreads and make money because everything's going up together. And it sort of became an unnatural market for what we were doing. Mm-hmm. And around 2014, we basically returned our investor capital and kind of went into search mode and tried to figure out, well, what next? Mm-hmm. And we were looking at so many different ideas, and ultimately we came back to what we're good at, which is finance. Mm-hmm. There's a backstory as to how we got into real estate as well. Max and I had been doing some private fix and flip transactions. We were the capital.
So you were a builder. You were on the side.
Well, they were slightly more passive, the transactions. There was we partnered up with someone that was sourcing the deals and handling the deals for the most part. But as a result of that, we sort of learned the business.
Right.
And yet at the time we didn't really know what a fix and flip loan was. I had never heard of such a loan. I at the time, I guess it was called hard money. But I really didn't know what it was. And we, in our looking at various strategies and different things, we happened to get introduced to a private lender. Actually, Arvin also knew through his contacts some private lenders, and it was basically a chance encounter. And we interviewed that lender. I won't name that lender here, but he sometimes calls himself the founder of Roc Capital, which by the way, I call Roc Capital 2.0, because it was a completely different strategy. It was a completely different business. We went from having 100 people in Roc 1.0. We went down to 5. Back down to 5. It was Arvin, Max, and myself, and an admin and a programmer. And we started from scratch again. And that's what I call Roc 2.0. Has the same Roc name, but a totally different company. Right. And so the basic idea with that private lender was he was doing about 100 million in fix and flip loans a year at that time. And, he offered us to invest in his loans. At the time, most fix and flip lenders, what they were doing to fund themselves was they were raising friends and family money, and they were chopping up the loans and syndicating them. That was the most common strategy to fund loans. There was no real institutional capital in the space.
No.
And the basic idea was, well, if this one little lender here in New York that I just met by chance, he's doing 100 million a year, there must be hundreds of guys like this. And I bet we could start a fund around this. And at that time, the housing market had bottomed out. It felt like there was no room to go down. It was, post-crisis. There was just an endless supply of inventory that fix and flippers had coming out of the crisis, out of distress, out of the foreclosure markets. And we decided to do, at that time, we called it the private lender program. We created a private lender program, and the idea was simple. The lender puts up a 10% B piece in the loans. We put up the remaining 90%, and we go and raise a fund to fund those B pieces in the loans, and we'd fund private lenders across the country. That's how we got started. And
that model sustained you guys for a long time. I mean, that's still partially what you guys do. I mean, it's still kind of like a variation of that, essentially, right?
Yeah,
one component of your business.
There have been many iterations since, but what still remains is the private lender program.
Right,
we still do that today.
And that's really interesting because it all happened by, and I always lately I've been on this human element kick and like talking with a lot of sponsors, and there's that the opportunity came through essentially a network of things that it wasn't related to your normal day-to-day business as a hedge fund manager or anything like that. It was through some projects that you had invested in privately, and you happened upon the space.
Well, it was the synthesis of all of the above. So we were in the hedge fund space, which enabled us to, 1, raise capital, 2, understand how financial markets work. And if you remember the brand promise, I said, our platform connects Wall Street to the farthest reaches of Main Street. What we saw was an incredibly fragmented marketplace of lenders that were unable to fund their book of business
Right.
And we're really adding value to the economy. I mean, what they were rebuilding America's housing stock.
Exactly.
I mean, that's the, and it made no sense whatsoever. The returns were very high. They were lending at very high rates, and it was win-win for everybody. It was win-win for the borrowers. The borrowers were making money doing this. They were changing and transforming neighborhoods. It was win-win for the lenders, right? The lenders, the borrowers made money. The lenders were happy. The lenders made money, and this funneled all the way up to Wall Street. And we felt that with time we could make this more efficient for everyone. We could institutionalize the space.
Right. And I remember when you guys came on the scene, because that's kind of like I started in this space around 13, and I remember you guys jumped on the scene like in 14, 15. And we started seeing you guys at, the trade shows and stuff like that. And all of a sudden the market just exploded, right? And you guys are partially, I feel like you and a couple of the founding groups that brought a lot of the Wall Street capital to the space were kind of, to credit for that, right? Where the space has become much more highly regarded, in 2012, 13, it's exactly as you described it. Like it was kind of, what is that? And what do you do? And it wasn't a well understood type of industry. It still kind of isn't, but you guys were really instrumental in helping bring that level of recognition to the space and help it grow. But I want to talk about how you guys grew from there, right? So you guys created a new business model for yourselves in 14. The 5 of you said, right? 3 partners and 2 staff members. And today, I mean, now there's Roc360 and with all these ancillary services that you're offering to really make it easy for an investor who's investing in real estate, let's kind of like walk through the evolution from 14 then. Like, when did you guys really start scaling and start seeing that momentum behind you guys and toward the company you guys are today? Because it's a relatively short story, right? Because a lot of the folks we talk about had all these struggles from like 08 and coming out of building out their business. You guys really exploded from 14 to today, and it's a very short ramp up and have been very successful in doing it. There must have been, crazy stories in the growth process. I mean,
definitely a lot of crazy stories. Well, it's all relative, I suppose. I mean, it's actually been 7 years at this point. So it's,
yeah, but that's relative. I mean, 7 years is not a long time to build a business of your size. And that's interesting from my standpoint, because you guys have the access to Wall Street and you have that experience, but there's also the operator component, right? You have to operate the business, and capital is capital. You have to operate, right? And so, I like to hear about the operations of businesses, because that's something that it rings true across the board from a managerial standpoint. Like,
sure,
building that must not have been easy, over the past 7 years.
Yeah, well, to give you some perspective, we were a few traders used to clicking our mouses and entering trades.
Right.
Into a Bloomberg terminal or some trading software. We each had like 6 screens, and we weren't used to managing a lot of people. Well, now our headcount globally is 250 people.
Right.
So
over 7 years. That's crazy.
Yeah,
that's awesome.
Yeah. And, it goes to show you how different we are today than, I mean, this is an operational business. This is very
Absolutely
different than trading equities.
And you don't have the resources that a big bank has to, make your life, just general operations resources that it provides. You're responsible for that as a principal, right? And so taking that from 2014, like the first big kind of like jump for you guys, when you guys really started to feel the horsepower, if you will, like when was that?
I would say that in hindsight, we could have grown much more. We were very conservative. We're a very data-oriented, risk-oriented group. And our growth wasn't hockey stick type of growth. It was slow. It was slow and gradual. There are other players that came onto the market and, aggregated a lot of loans very quickly. Our model was not like that. We did have an aggregation model, a third-party origination model, but we actually funded every single loan that we ever made. We never, ever bought a loan, which differentiates us from the aggregators in the space who set up programs to buy loans.
You guys were funding alongside the sponsor, and that was really important to a lot of people. Like they wanted you, they knew that you were kind of a partner with them and almost like an investor with them. And they had skin in the game with you, and that was a very different. A lot of my clients that worked with you were talking about that. Like we have to have skin with them, and they want that. And I thought that was a good thing.
Yeah, skin was very important for us to learn the business. And at some point, a few years down the line, we realized that we didn't need it anymore, and that we were perfectly comfortable. And then we created programs that didn't require having any skin in the game. Obviously, the economics were different. If you've got skin, you capture more of the economics, and if the less skin you have, the less of the economics a lender was able to capture. But as we removed some of those restrictions, well, then the volume started growing. And as our cost of capital went down over time, the result of more institutional capital coming in, bulge bracket investment banks offering warehouse lines, securitizations getting done, our investor base became very diversified. I'd say when we started, it looked more like a bunch of hedge funds. And where we are today, I mean, we have committed capital from insurance companies with a totally different return bogey or return target, and the profile is just very different.
Right,
it's a stable long-term capital.
Right. And I want to talk about like kind of from an inside operation standpoint. You guys, when did you guys start adding a lot of people and making a lot of those key hires? So I remember you guys seeing you guys more often at the national events, and really you guys were picking up your marketing game. But I saw you at every event though, right, as the principal, and you still go to a lot of the events. But you guys grew as a company, right? You guys added, back office, front office, marketing, and all that kind of stuff. And like, when did all that started to happen for you? Was that immediate as you guys started to pick up origination and volume, or was that after 2-3 years? When was that? Okay, we got to start hiring and growing this group.
Yeah, I would call it gradual and linear throughout, and until COVID happened.
Yeah.
And when COVID happened, for very, very brief period, we had to let a few people go, but literally within weeks thereafter, we realized it was an opportunity of a lifetime, and our headcount went from the low 100s to the mid 200s.
Oh, wow.
So
this is during 2020?
This is during 2020 and 2021.
Wow. Wow.
Yeah.
When most people are having trouble hiring people, you guys doubled your working group. I mean, that's a lot. That's fantastic.
That's right.
Yeah. And what created the need for that? Like, was it just like, oh, we have such an opportunity to hire great people and we have the need for it? Or was there a specific like event that happened that required you, okay, we need more people. This is absolute must.
First off, we were able to continue lending through COVID.
Right.
We stopped lending for maybe a week or so. It was really our own choice. It wasn't forced upon us. We didn't have any margin calls. We were unlevered. We had committed insurance capital that was willing to see the crisis through. It became very clear very quickly that just like in 2009, which was a different sort of crisis, government was going to step in and really put kind of a backstop to the kinds of problems that could happen. And our thesis very quickly became that real estate was going to be a beneficiary of everything that was happening. It just so happened that many people in the space were not similarly situated. They were actually levered up, and they went through a period of deleveraging and margin calls.
Right.
And a lot of people were not able to lend anymore, so they had to let go of their employees, and we frankly were able to take advantage of that, and we are in a very strong place today. The result of that, I hate to say it. I mean, it was a global crisis, and it still is actually. But some people fare better and some fare worse. We always obsessed about keeping risk as low as possible, keeping leverage as low as possible, or none at all, which was actually our way to go about it, because we'd seen it before. We saw this play out before. We saw deleveraging cycles happen before in 2009.
So when you guys were capitalizing from 14 till 2020, you were unlevered before that. So before COVID, you were unlevered.
We were
committed capital, no
COVID.
leverage.
That's right. We were unlevered coming into COVID. Our business model was to originate the loans and place them with a diversified group of investors. And some of those investors, of course, committed investors.
And that's very uncommon. I mean, from an institutional provider, I think you're probably the only one. That's fantastic. I mean, that's probably why. I mean, that explains a lot. Explaining why you guys were able to jump back in so quickly. Let me ask you this though, like the phenomenon that is today though, right? Post-COVID, like August-ish of last year, 2020, the market kind of like exploded, I feel like. And there's just hyperactive, on fire. So many, people are joining the space, both from, kind of like people who are what I would consider your colleagues or competitors. And then also on the Main Street side. And you guys have grown as a benefit of that. And, what are you guys doing right now? Like what's the big thing right now you're pushing for as a company? Because now, everyone's repositioning, kind of pushing in different angles for different products since August of 2020. Now we're a year later. What are the things that you guys are pushing for right now and working hard on right now?
Well, look, the whole 360, funny to call it an angle, but the 360,
it's a vertical. It's angle vertical. I mean, the idea is like, what are priorities for the company right now to really, continue growth, and what's a priority for you guys?
Right. So first off, we're a data science driven company. We have data scientists on staff, almost 10 data scientists on staff. And I think where we add value most is in first figuring out risk, creating new products, and frankly, helping our originators with their origination, right? So that may be by providing them with leads. That may be by helping them be more efficient, handling more of their back office, having a white labeled borrower portal. Right, in the third party originator's name, by facilitating automated insurance solutions, by integrating title into the transaction. So that layer, that is, how do we create more deal flow? How do we use our finance skills to make sure everyone has the lowest cost of capital possible? How do we provide a platform that makes the process more efficient for our third-party originators and for our borrowers, for the borrowers of our third-party originators? Right. We're attacking it all from all sides, and we're just seeking to make it more efficient and
make it easier to buy, make it easier to transact, make it easier to operate with Roc.
Make it easier to transact. Yeah, I mean, if you really think about it. What's happened in the world over the past 20, 30 years? I mean, you went from a world where it was all analog and you had to go to a shopping mall to buy the things you need. And well, what's happening now? E-commerce is becoming a bigger and bigger segment of retail. And that's the same here, right? I mean, we're automating and adding technology, layers of technology to a complex process. I mean, it's definitely a complex process. There's a lot of
very much
parts.
So.
A real estate investor transaction has a lot of moving parts. And in the end, we're really addressing a tremendous housing crisis in this country. basically the products that we're creating are bit by bit addressing a really staggering housing crisis in the country, an undersupply crisis.
Massive undersupply. Massive. It's insane. But that kind of business model, though, right? Adding all of these verticals to make the transactions easier, right? Both for the originator and for the borrower in a lot of regards, making everything easier. It adds a pretty hefty administrative load and operations load to a company, right? And I talked internally with our team members here that work with your guys's behind the scenes groups, and they were talking praises about, I think Lucas came up and shout out to Lucas on your team. They're speaking his praises, but I don't know. A lot of us don't know behind the curtain, and kind of one of the themes of this show is to kind of look behind the curtain a little bit. And tell us a little bit about the behind the scenes company and the culture of the company to really execute well on those types of products. Because insurance, lead generation, even helping them with the underwriting, because you guys have that as part of the white label. That is no easy feat to maintain, customer service, making sure that the transactions flow smoothly, but also as executives making sure the company is not, there's a lot of oversight over the redundancies, right? Because people come and go and that kind of stuff. So talk to me about the culture of the company, because those things are not easy to execute on in 7 years. That's another thing. A lot of our guests on the show, have built these crazy back offices, but they've been doing it since, 20, 30 years. You guys have done it in 7. And tell me about how you guys have achieved such fast growth from an operational standpoint, but and the culture that aligns with that.
Well, first of all, I think the reason why clients come back to us is, first, we have a flat organization.
Oh, you do? Okay.
We all sit together in a trading floor type of setup. Maybe that goes back to our old days.
So it's a big pit of a bunch of desks.
It's just a bunch of desks, and that's Wall Street of old. But actually, that is a flat culture. Nobody has private offices, and in that sense, it's a highly collaborative endeavor. Mm-hmm. I'd say we're an employee. By the way, we're an employee-owned company, 100%.
Oh, fantastic!
We don't have any institutional sponsor at the moment, and this is our baby. Mm-hmm. And the founders are always there. The founders are obsessed with getting every deal done. Our clients know that. Mm-hmm. We fight as hard as ever to make sure that our clients are getting the best service possible. And that's not easy to do. No, it's not. Candidly, most of my day is dodging a lot of people that are not always thrilled and trying to fix the problems that come up, because again, this is an operationally intense business. So what differentiates us? Well, it's employee owned, so it's our company, and we're just obsessed about getting it right for the clients. That's a huge differentiating factor relative to companies that are institutionally owned or VC backed. There's sometimes not quite that level of intensity at companies that are not kind of held.
So everybody has an ownership interest as they come working for Roc. They get there's an ESOP plan for the employees, and everyone owns a component.
No, though we're working on that now. No, we're closely.
We're almost there. Okay.
Well, that's certainly in the works. Yeah. As we grow, it's important to retain talent that we find ways to have our employees participate in our growth, and we're certainly working on that now. Right.
And you talked about kind of the shared workspace and the open workspace, but there's also a component. You guys have offices in multiple countries. Managing a remote work staff. We did it in 2020 via Zoom here in California. For us, was hard enough. having people overseas. I mean, talk about that really quick. It must be very challenging for you guys to do that. Time differences, cultural differences. I mean,
well, we all have mixed feelings about remote work. I mean, much of our headcount, or maybe most of our headcount, is in New York. In any case, but yeah, sure, we've got offices globally, and especially during COVID, we all went remote. Look, like the global economy. I mean, if you look at the GDP numbers that just came out in the U.S., we're back to pre-COVID levels, and yet Manhattan is only 50% full these days. Well, what does that mean? That we're able to do the work that we were doing and yet not come to the office. So we're getting it done anyway. And by the way, we're back to the office now. But we're getting it done. And I would say that remote work was not the tragedy that we thought it would be in March of 2020. In March of 2020, when we had to kind of close shop and I mean, we thought it was a calamity. I mean, we really didn't know how we'd get through that, but we just kind of all rallied and got there, just like all other companies around the world, and that worked out well. I mean, Zoom and other virtual meet platforms are very powerful, and they work pretty well, and our whole team is super dedicated, and everyone's on the ball, and everyone wanted to make it work, and we made it work. It's really not a problem.
Fantastic. I mean, and you mentioned that level of intensity, and to keep that level of intensity during a time where you're working from home in your pajamas via Zoom. I mean, I've always, I've had problems with it, but I just can't be as intense when I'm sitting in my bedroom in my pajamas. Yeah. And you're right. I mean, we do have to make, accommodation, figure it out and get it done. But you guys came back to the office, and you're all back now in New York in the headquarters. But is there a remote option now? Is that like, if you want to work from home, you can, or are you guys?
Yeah, there is a remote option. I mean, I think since we realized that, that it's possible to work remotely, I think it may be difficult, frankly, at this point to mandate that everyone come back to the office.
We can't do that. I mean,
again, we're experimenting the same way everyone is. I don't think it makes sense for a lot of young people to work 5 days a week from home. I mean, that's just not a path to career growth. Right. But I think some hybrid schedule is probably fine. And by the way, this is not a business for the week. This is not a business where you can just lounge around. I mean, we had $1 billion of loans come into the system this month. We closed almost 250 million in loans this month. You can't take your eye off the ball for a second. There's no slack anywhere in the company. There's just no room for it. So when you say, it's hard to stay motivated, well, it's hard to take a nap during the day. I'll tell you that.
That's true. That's very true. You're not able to, and I think that's what makes you the choice in a lot of respects. You may be in your pajamas in your living room, but the level of work doesn't change. It just happens to be remote, right?
It doesn't change, and frankly, I think a lot of people were working more than ever. I mean,
that's true. There's no one's going home. No, you're home. You just keep working.
Right. You just keep working. Right. You just keep working. So that worked out well.
Well, I want to shift gears a little bit and get, we talk a little bit about kind of the private lending industry at large. And that's something that I wanted to get your thoughts on, because you have a unique perspective on it, because, you have, the institutional background, but at the same time, you're partnering with these lenders in a lot of respects, especially during the days when the model required the skin in the game. And I want to, you kind of touched on this, like how the industry has evolved, right, since when you entered in 2014. And I want to get your thoughts on it right now, current conditions right now. It's 2021. I mean, I feel like August, maybe even June of last year, this industry is on fire. People are doing record numbers. You guys, you said $1 billion in origination volume coming in in a month. I mean, it's just insane. And lenders all across the country are telling me they're doing record months. What are your thoughts? I mean, this is a crazy time. Cost of capital has never been as low as it has before in the space, and opportunities to fund have never been as large. And we're seeing a lot of commoditization and standardization. Securitizations are happening more often. I'm just kind of, there are times where I'm like, how did we get here? Sometimes, right? This is crazy. And I give a lot of credit to companies like yours, but I want to hear from you guys. And what are your thoughts on kind of like where we are today and how we got here?
Well, first of all, it's a good asset class, right? Delinquencies on real estate investor loans have been low. The backdrop to that has been an incredibly strong housing market. Low interest rates, an incredibly strong housing market. I think Wall Street has come to realize that this is a pretty sweet asset class to be part of. And so as the Wall Street money comes in, product guidelines are created, standardization happens, and when I said the market was fragmented when we got in, it's defragmenting now, right? It's becoming less and less fragmented, the capital is kind of reaching the farthest corners, and local lenders are seeing that. Yeah. And so, yeah, you're right. It's all of the above. The backdrop of a strong housing market, institutional capital coming in, imposing from a high level guidelines, and that's trickling down. I mean, there are still pockets of the Wild West happening. There's still some lenders that call themselves hard money lenders.
Hard money still exists in some places, parts of the country. Yeah,
it still exists. But for the most part, the private lending industry has moved away from a loan to own kind of mentality. I'm not even sure that it wasn't there when we got into it. There were some pockets of that.
Yeah,
it was all about the borrower being successful, the lender being successful. That's still there today, and we're just standardizing it, and the more we standardize, the more professional the space becomes. It just starts to look and feel more like a mainstream product, and that's great for everybody. I mean, look at what happened in the housing market in the last 12 months. The unprecedented spike in the housing market. Home price appreciation is up 25%. We've never seen such a move on the upside in such a short period of time. Really unprecedented. And look at what it's created. I mean, if you think about it, the housing market pre-COVID was roughly $35 to $40 trillion. 20% of that is owned by real estate investors. Now, the housing market appreciated by 20 to 25% nationally on average. So now it was worth 35 to 40. It's worth what? Close to $50 billion now. And take 20% of that. That's 10. Sorry, I used the word billion. It's trillion.
It's trillion. Yeah.
Trillion. Yeah. So 10% of that, or 20% of the total housing market is roughly $10 trillion owned by real estate investors. Now, interest rates are at record lows, and all of those properties are eligible for some sort of refinance long-term loan.
Right. And that's the craziest part. The funny part was that we were at a seminar about 4 years ago, and someone had gave us an estimate about the industry, the private lending industry. So real estate investor held residential real estate was approximately about $3 trillion. And now it's approximately $10 trillion in value. And that's the crazy part. It's just climbing and climbing and climbing. Although that does kind of make me nervous. And the continuous growth, right? It's just continuously increasing in value. And these
are all guesstimates. So maybe I'm not sure the $10 trillion is entirely correct.
Could be, right? We're guesstimating, yeah.
Right. So maybe if it make the growth of the segment. Actually, I remember I remember looking back at stats from the National Association of Realtors, and pre-crisis, I'm talking 2009 financial crisis and post-crisis, the level of real estate investment remained pretty static. It was 20% annually. So of all homes purchased annually, investors kept a pretty consistent share of that at around 20%. So the crisis didn't actually change that much. What's staggering is, first of all, home price appreciation in the last 12 months. And the real estate investor segment itself, I mean, I guess you were alluding to maybe it feeling frothy. Is that?
Yeah, very frothy, and sometimes that can be a bad thing, or dangerous thing,
Well, first of all, the fix and flip segment is a small segment.
It is
only $50 billion a year plus or minus get fixed and flip annually. Again, the size of the consumer market that gets transacted annually is 1.6 trillion. So the 50 billion is such a small piece of that 1.6 trillion that's trading annually, right? It's really a small little tiny piece. And what's really happening in that bridge space, right? They're fixing up old houses. By the way, your average house in the US is what, 30 or 40 years old, all up for being, fixed up, made more green, more sustainable. I don't really see an end to it, frankly, given the undersupply. You're right. The investor segment may feel a little bit frothy, but the backdrop is a very old housing market,
right?
A massively undersupplied housing market. Those are long secular trends. This is not a trade right now.
No,
it's not like a quick hedge fund trade. Let's go long and then let's get out. No, this is a secular thing that's happening.
At the same time, right? The issues that a lot of folks have identified when it comes to the rehab component, right? While the aging inventory is still, there's plenty of it out there, right? That's fine from an inventory standpoint. And that's a good target play for the rehabbers. The challenge seems to be we're running out of room to build, right? There's not as many places to build. People don't want to live in the desert, right? People don't want to live in the mountain. They want to live in the community.
Are you sure? With especially post-COVID.
Well, that is true, right? And we're starting to see secondary, tertiary markets really boom. But when I was talking to some retail folks in Texas, and there's even saying, and even in Texas with this, we have a lot of land. There's only so far that developers want to go to build houses because they don't want to live too far from the city, right? And so, or from the suburbs at least, and that raises some questions on my mind, like how can we solve this massive undersupply with just that small fix and flip component, right? And how can the only way to do that is to build more housing, right? Like actual new housing that has to be built. And I think our industry does play a part in that. We're not the major driver of it, but we play a part in it. But what are your thoughts on that? I mean, the need for more, not just repairs and rehabs, but the need for more new housing, because you can't find a house to buy right now. If you're a buyer, you cannot find a place to buy right now. And that's the craziest thing.
Yeah, we're developing products that address that, including new construction products, build to rent.
Right.
Yeah, there are elements of, I think the perception post-COVID has changed a little bit, and people feel like if they're not glued to daily commute and coming into the office every day, that they can live further away, at least at the margin, they can live further away from urban centers. And that actually, that shift in perception is really causing, is one of the factors that's causing this boom in the suburbs around the country. But I think that it's also opening up opportunities to build in places where people were not planning to build before, right? Mm-hmm. There's plenty of land. It's just,
desirable though. That seems to be the balancing issue for folks, right? Do I want to build this far away from some type of density, right? That seems to be the challenge, and
sure.
It's going to stop us from building more houses. That sentiment is going to stop us from building more houses because we need houses. We need houses.
I mean, I think the local governments are trying to address that through urban planning, zoning changes as
Let's
well.
hope.
It's a mix of all of the above. It's not just by building up the suburbs that we're going to solve this problem. I mean,
no, not at all. Not at all.
Smart cities will find ways to address local problems as well by changing zoning. I keep on talking about Japan because I happen to.
How many years has you spent in Japan?
I didn't live there for more than a year, but
you were in Tokyo.
Yeah,
awesome.
But actually, Tokyo is an interesting place for so many reasons. By the way, one is with respect to what happened in their housing market. Actually, they have much less restrictive zoning than we have here in the U.S., and so they're not seeing the undersupply issues.
You can build anywhere in Tokyo. You can build a house, you can build an apartment, and you can build a restaurant all in the same place because everything's gone vertical. They don't have as much land as we do, right? So they have no choice. Same in Korea. Like that's why I know it very well. We have the same model in Korea. Like you can build a restaurant underneath an apartment, and it's not a problem.
So that I think zoning changes will have to be a part of addressing the problem.
Make it easier to build, right? The zoning, the getting your permits is definitely a problem. At least where I live here in California.
Sure.
I want to kind of transition now, and we're almost out of time. I want to get to know Eric a little bit more because we've had some discussions. We got to know each other over the years. But a lot of our audience know Eric from Roc, and we've seen you on stage, and you have a great stage presence, talk about data and the industry. But a lot of us don't know Eric. But where you grew up in New York, right? You're from New York, born and raised, or where'd you grow up?
I was actually born in Atlanta, Georgia.
Fantastic.
My parents are from Russia.
Okay.
And they came to this country speaking not a word of English, with $75 in their pocket. I don't even know where they got that. But my dad was an engineer, and eventually they made their way to New York. I grew up in Queens, middle class kind of family. My dad was an engineer, an electrical engineer. He actually moved on to designing solar panels. Cool. So that was pretty cool. Yeah, a product of New York City public schools. Nice. I then went to NYU. I got a degree in my bachelor's in finance and actuarial science, and a minor in math. So definitely a quantitatively
data-driven guy. Yeah,
definitely.
Were there thoughts back then to go into the actuary or the that kind of business, or were you always going to go into finance?
Life is funny in that way. I went to business school in New York, got a job in New York. It was on Wall Street. Wall Street was an amazing place at that time, right? It was 2000, around 2000. It was booming. I got that job at Deutsche Bank. I learned how to program. They entrusted me with the culture on Wall Street was pretty wild at that time too. At that time, my manager Arvin, he said, "Hey, why don't you just start a portfolio in Japan? I don't know, a few $100 million." And I thought to myself, "Are you sure? I'm like 22 years old." Wow. That doesn't sound like a great idea, but anyway, they trusted me, and that was amazing. That was the culture. If we could handle it, it was given to us, and obviously I didn't do anything wrong there, and that worked out well. And yeah, I mean, I basically have been in New York the whole time. With some stints in London and Tokyo. definitely a product of New York.
Very cool.
And so is our business, by the way. We were very regionally focused, and we eventually converged with you guys on the West Coast. It took some time. You probably didn't know much about us in 2014 when we started, because we were very kind of New York tri-state focused.
Right. And that's one of the things I regret looking back. Like, man, we should have had a New York office back then.
Actually, one of my biggest regrets in this business was not having a proper presence on the West Coast early on, because frankly, California is the biggest market in this space for the type of stuff that we do. And it's amazing that we built what we built having almost no presence there in the beginning stages.
Right.
So that's definitely something that I regret. And
well, in the next cycle, right? Next cycle, we'll be okay.
we're doing it as part of this cycle. But.
Exactly. And so, like, I had to close with a personal segment. So, what's one thing that not most of our audience knows about Eric? Because we hang out a lot, we see each other at conferences, and we go out for dinners and drinks and stuff like that. But what's one thing that a lot of us don't know about you?
I play the piano a little bit. I play
nice.
Piano, a little pop. I'd be happy to put on a demo for you at some point.
Yeah, we'll get a piano on one of the shows. We'll get it on stage.
Yeah.
Nice. Sometimes the conference centers will have a piano just sitting in the hallways, so maybe we'll just prop one up for you one of these days.
Definitely sounds like a lot of fun.
All right, man. Well, during cocktail hour, right?
I'm ready for it.
All right. Sounds good. Well, I think that's all the time we have for today. Eric, thank you very much for joining us on this episode of Lender Lounge. We'll see you at the next conference for sure. And look out for Roc and Roc360 and all the great things they're doing in 2021 and beyond. And we'll see you at the next conference, Eric. Looking forward to it.
Thanks, Kevin. This was a lot of fun. Really appreciate it. And thank you for your partnership. We're always thrilled to work with you guys, and you guys have helped us expand in California, and I really look forward to strengthening that. And
I appreciate that, and thank you very much for that. And definitely ditto to you. And here's to a great 2021, and hopefully the rest of the next few years so forward. So we're going to be doing well going forward. Thank you very much, Eric. And that's all we have. That's all the time we have for today. And once again, this is Kevin Kim from Lender Lounge. See you on the next one. Thanks for listening to Lender Lounge with Kevin Kim. I hope you enjoyed this episode as much as I did. If you did enjoy, please leave us a 5-star review on your podcast platform, and be sure to follow our show to be notified of new episodes. If you're on YouTube, don't forget to smash that like button and hit subscribe for more content from all of us here at Gerasi. Lender Lounge with Kevin Kim is available on all podcast platforms. Referrals really help us spread the word, so please send this over to someone you think might enjoy it. See you next time. This is Kevin Kim, signing off.